Hey, I'm really happy that you came on with me. And I just want to talk about what has been going on. And my first question to you is that are these world economies, I mean, we saw the stock market come down dramatically in Asia, Europe, and then it hit the United States. Are these world economies growing? I mean, do we see growth in all these economies, or is something else happening here? Is it basically shrinking, contracting?
Well, I have two answers. One's a
Okay.
short-term answer, one's a longer-term answer. The big cycle, the big thing that I think everybody needs to be aware of. This is what I wrote about in the Crash Course of the book. It's also a video series online, all free. People can just tune in and watch. I think this information is critical. The big thing we have to be aware of is that starting in the late 70s, early 80s, the United States went on this credit binge, and we just started borrowing at about twice the rate that our underlying economy was growing. I mean, you don't have to have a PhD in nothing. You don't have to be an economist to know that if your debts are growing faster than your income, eventually you have a math problem, right?
Mm-hmm.
So that's what we were doing as a nation. And, between 2000 and 2008, our nation's debt went from 26 to 52 trillion in those 8 years. It sounds extraordinary, but our debt had been doubling literally every 6 to 8 years for the past 45 years. And 2008 was the shot across the bow. That was the time when we should have said, oh, okay, that was dumb. Maybe we shouldn't have been borrowing that much. My prescription for what was happening was three words. We had too much debt. Well, instead of taking the pain, it's painful to recognize that, saying we were wrong, all of that, what we did as a nation and as a globe is we said, let's just put more debt on there, right? So the Federal Reserve lowers interest rates to zero, and governments go on these borrowing sprees because the households have backed off, and corporations start borrowing like crazy. They're buying back their shares. It makes perfect, CFO sense, but it doesn't make a lick of actual long-term sense. Doesn't matter. So here we are. We've got interest rates at zero, but guess what? All of this stuff that was supposed to stimulate economic growth actually did the opposite. And this is, I think, people are starting to recognize this, starting to understand what's really happening with this stuff called quantitative easing, is that, look, yeah, they threw a lot of money into the markets. Yeah, absolutely. You get rising stock prices and bond prices. Certainly we had those asset bubbles come out. The problem with asset bubbles is they burst. You get that financial boom, you get the financial bust. We're on the bust side of that story at this point. Very dangerous ground right now. But the other thing you get when you put too cheap money into a system is you get all this resource misallocation. People do stupid things. They put money into things they shouldn't have done. That gives you lower productivity. That gives you less economic growth as well. And then the last thing that happens with QE is just a wealth redistribution. It's a reverse Robin Hood, right? You take from everybody and you give it to the ultra wealthy. But guess what? That higher inequality, those ultra wealthy people, they spend less on a percentage basis than anybody else. So by taking all of this money and basically funneling it into just a very few billionaires' pockets, that also gave us lower potential growth. So that's where we are. We're at the cusp of this financial boom bust. We have all this lower productivity and we have this higher inequality. All of that combines. It gives us low growth. That's what we've been seeing. Unfortunately, since 2008, the world as a total has poured on a little over $50 trillion of new debt. We are now standing at $200 trillion in debt worldwide. That has to be repaid at some point. It only gets paid out of future growth. That future growth isn't here. Our central banks shot us all in our collective feet with this one. That's been my main critique and complaint about everything the central banks have been doing. So, hold on to your hats here.
So the corporate media right now is out there, and it seems like they're laying blame for all of this that we're seeing right now on China. They're saying, oh, China did this. They devalued their yuan, their stock market's crashing. It's affecting us. I mean, we know China has been purchasing a huge amount of gold. We understand that they've been making bilateral agreements all around the world. I mean, do you think this is just from China? Or do you think this is, I mean, you've been saying it's from something else since 2008. So can this be blamed just on China?
not just on China, but there is a little bit of blame here. And China has their own can of worms that they've now opened up for themselves. The biggest deal is that China had predicated itself on industrialization. And it did a bang up job. I mean, if anybody, I haven't visited, but people who said, before and after, go to China 10 years ago to today, it's astonishing. High-speed trains, buildings everywhere, new, subways, cars everywhere now where there used to be bicycles. But what China had done is it had hitched its wagon up to this idea that fully half of its economic growth was going to come from building stuff. Well, they way overdid that. They built out everything they possibly need. They have way too many houses, apartment complex, ghost cities, all of that. And they've got a lot of that misallocation of resources we talked about before, because China took their debt from about 8 trillion to 28 trillion from 2007 to current. It's just an astonishingly fast pace. Of course, they made a few mistakes along the way, but they got this explosive growth out of it. 7% a year means your economy is doubling every 10 years. That vacuumed up massive amounts of resources from the world. They were burning half of the world's coal, half of the cement, half of the iron ore. They were importing oil year over year at this furiously increasing clip. Everything you want to mention. So China was doing that, was vacuuming up all the world's resources, and then it was the world's manufacturing center. So it had all this capital flowing in, and then that capital was flowing back out across the world. So there was a stability. Here's the thing about financial systems. They love expanding. They do that gracefully. And there was this whole expansion phase. Here's the dark side of financial systems that we've got for ourselves. They don't contract at all gracefully. In fact, they threaten collapse and get very cranky about the whole thing. So we're in a very big structural position right now where China's prior behaviors and resource flows, both into and then back out of the country, are all being turbulently disrupted right now. And, if you're in a resource country that's been exporting heavily to China, like you're Australia, you're Canada, you're in deep trouble right now. If you're Brazil, you're in deep trouble. So what we're seeing now, this all, China's a part of this, but you can't lay the whole blame for what's happening. What we're seeing now is the classic bust phase of a global expansionary phase. The central banks shot their wad, they printed up tens of trillions of dollars, threw it into the world, crossed their fingers, hoped for this rapid resumption of growth. It didn't happen. And now we're on the backside of that. And, my advice is just, you want to know what's going on in the world. Don't pay attention to the S&P or the Dow. Just take a look at what's happening at the periphery. Watch the credit spreads in Brazil. Watch what's happening to all the different currencies in the emerging markets. Because that's where the trouble always begins. We're seeing some warning signs right now that this is one of the most turbulent periods of peripheral contraction that we've seen in, 15 years.
So let me just get this straight. So you're saying right now that we shouldn't be watching the stock market. I mean, we saw it drop, and at one point it came down to like 1,100 points or so. One of the biggest drops that we've ever seen. And then we've seen the market being pumped up again today. They're saying it's Terrific Tuesday. And, we came from Black Monday to Terrific Tuesday. And what we're seeing right now is everyone's, of course, is saying, oh, it's all over. Everything is fine. You see, it was just a little correction that we needed. Obama's out there saying that, the economy now, because of what just happened, is stronger than ever. I mean, should we say, okay, everything is fine right now?
Absolutely not. That's, on Wall Street, the old saying is, stocks are for show, but bonds are for dough. The stocks are really for show, right? It's the main signaling mechanism to tell people either things are okay or not. I mean, if you just look at the absolute look of horror on CNBC and other newscasters' face yesterday when they were confronted with that 1,000-point drop, right? Just how shocked and disappointed they were. Well, listen, any precious metal investor would say, geez, I'd take a 3% loss instead of a 12% loss any day. That kind of volatility used to exist in our markets all the time. It was not a particularly, on a percentage basis, an unheard of event. But look how shocked everybody was. And so I'm convinced that the stock market is mostly a signaling mechanism. And Bernanke was clear about this. Look, he wrote an op-ed in the Wall Street Journal and said, we're going to target asset prices, specifically equities, because when those go up, people feel better and they spend more, right? It's an open policy of the Fed to have boosted asset prices. mostly because he adopted Greenspan's flawed reasoning that asset inflation was the same thing as wealth. Huge mistake, rookie mistake. It's going to be a bad one when this one finally goes away. But I am not watching the stock market for anything other than to see how my friends and neighbors are going to be reacting the next day. If I want to predict what's coming next, you've got to be watching the things that actually matter. And so, I don't watch the overall market per se, but I do watch the subcomponents where I think the trouble is going to show up first. If it's anything like 2008, we're going to see it in money center banks, in insurance companies, other interest rate sensitive companies like utilities. If we start to see things that are going to blow, that's what's going to show up first. So, they can keep the market elevated simply by making sure that Apple, Google, and Amazon have a good day. But underneath that, you might be having a lot of trouble showing up. That's where you get your first warning signs.
Well, let me ask you, the Fed, is out there, and I heard on a lot of the financial channels how they were like, oh, the Fed has to step in, the Fed has to step in. And the Fed is continually telling us that they're going to be raising interest rates because right now we're at the lowest interest rates in who knows since when. Since ever, I guess. Are they going to raise interest rates?
I don't think so. Not if the market's, going to be in any sort of difficulty. They certainly wouldn't do that. Just optically, they don't want to be blamed for having caused a stock market decline. The Fed is a political institution. They are no longer independent, even remotely, and they don't have anybody super qualified on there at this point. If you look at who sits on the Federal Open Market Committee, the FOMC, you got a couple of academics and you've got a bunch of lawyers. That's it. People with JDs and PhDs, and that's it. So they don't really have people with good, solid experience at this point from a business background. So they're going to do what they need to do politically. And even if they did raise rates, now let's be clear about what we're talking about. Right now, the federal funds rate is set at a band between 0 and 0.25. I guarantee you all they would do is set that at 0.25. And the average daily rate is sitting at 13 basis points, which is almost halfway between 0 and 0.25. So really, if they, quote unquote, I'm using air quotes here, raised rates, all they would be doing is an eighth of a point hike. It would be completely meaningless from a liquidity standpoint in the markets. Banks have just gobs of excess reserves kicking around. There's gobs of liquidity floating around. It's really not going to meaningfully do anything. But optically, it would make it look like, hey, we're doing something. And certainly if you weren't focused on markets, which they shouldn't be, but if you said, where's unemployment, where's the actual growth rate in the economy, the Fed should absolutely, desperately be building a cushion for themselves so they have something in the toolkit that they can use when we get into the next crisis. Here we are, 7 years, closing in on 7 years into this bull market? And they haven't even begun the process of raising rates, and we're this close again, holding my fingers together, this close to another recession. What are they going to do? What's in their toolkit? Nothing at this point from an actual policy standpoint.
Let me ask you about oil. We see oil continually dropping. What's your take on this? Why is oil continually going down at this point?
That's something of a mystery. The meme that's out there says that there's this vast oversupply. When I'm looking at the actual data that's out there, it's not a vast oversupply, it's a slight oversupply. So there's something else that really got caught in the oil pricing. I'm not clear about it. I was always suspicious of the timing of it when it started. It was right about the time the United States really wanted to make a point to Russia. And it was just a little too cute by half. I didn't totally buy this idea that the Saudis were preserving market share because that's a little cartoonish. The Saudis produce certain grades of oil and they don't compete with shale oil, right? They produce these heavy sour grades that go into specific refineries. The stuff coming out of the Bakken and the Eagle Ford goes into a very different sort of a refinery. It's almost like saying milk competes with orange juice. They're just different. So I didn't really buy that. So I'm not really happy with the mainstream explanations of why the Saudis are pumping or why the oil started to drop. But here we are. And the one thing I can tell you for sure is there's massive misinformation out there about the ability of the shale operators to continue to pump at these levels and to make money. I've analyzed that very closely. They were losing money at 85, 90 a barrel. They're absolutely hemorrhaging here under 40. And there's just anytime you read somebody who's saying oh, these guys now have learned how to make money at 30. It's absolutely just a gigantic piece of PR is the politest way I can put it.
Well, yeah, I agree with you. I mean, if they were making money at, 38, I mean, why would they be laying off, thousands of people? I mean, that makes no sense whatsoever. Because if you're making money and your business is doing well, you don't lay off people. And as soon as this hit, we saw them completely, and especially in Texas and other areas, they just laid off tons and tons of people in the energy sector. And
Yeah, yeah. There's one other mystery piece to this, which is that almost all of the layoffs have been taken by the mids and smalls, so that makes sense. But the majors, so I'm talking the big boys here, Chevron, Exxon, all those guys, they actually are drilling at the same pace right now in 2015 as they were in 2014 and 2013. They're actually laying as much horizontal pipe under the ground as they have in the other 2 years. They're not dumb companies, and you can turn the capital on and off in shale very quickly. So the majors are busily drilling as fast as they possibly can in this environment. It's actually a money-losing proposition. Guaranteed they're burning cash to do this. If I want to get sort of business as usual, conspiracy-minded, this is the majors working as hard as they can to assure that oil prices stay low, because all they have to do is wait for the hedges to roll off, mostly in third quarter this year. And nearly all of these small and mids are going belly up. And then the majors, who were late to the game, could possibly get their hands on better shale acreage. And that makes sense. I mean, if I was in their shoes, I would probably do the same thing. And the reason for that is that the capital expenditure hemorrhage that happened over this past year and a half. And by the way, majors were cutting their capex back in February 2014 when oil was at 110. It's an absolute bloodbath for new projects. All you need is 2 to 3 years out, and we have a huge supply problem on our hands because existing fields are depleting at about 6 to 8% a year, depending on whose numbers you like. That means we need 5 to 6 million barrels per day per year to be found and brought online. That is not happening under current capex expenditure levels. So in a couple of years down the road, oil's shooting back up. If I'm the majors, I want to make sure I have as much of that shale acreage as I can get my hands on, because that stuff's actually really productive, and at the right price, it makes sense.
so, I mean, I've been reading a lot of articles, and a lot of them have been talking about the oil prices and what's going on in the Middle East to the petrodollar, and the petrodollar is basically on its way out. I mean, do you see this as right now that the petrodollar, where they're using the dollar to be placed on the oil sales, is currently on its way out?
Well, it's on its way up for two reasons,
Mm-hmm.
Dave. The first reason is just that you're seeing things like those bilateral agreements you mentioned with China, where they're just inking deals where energy is going to flow without any dollars involved at all. So that's a long, slow process. The faster process, which is absolutely earth-shaking this year, is that dollar recycling, petrodollar recycling, has actually gone negative this year. And just think about it, it makes sense. So Norway has this huge sovereign wealth fund. They get all this oil coming out of the North Sea. They export almost all of it because it's a very small country. They use very little relative to the amount they produce. They produce it, they sell it, and then they get dollars for it. And they mostly have parked those dollars into a lot of U.S. and European assets. So Norway was this giant machine that was basically just spewing money back into European and U.S. markets. That machine is now in reverse because their oil revenues have now crossed under their actual expenditure needs as a nation. So they're actually going to be in the process of sucking money out of their sovereign wealth fund this year for the first time in a very long time. That same dynamic, of course, has happened in Saudi Arabia. Literally any oil exporter, the same dynamic. Russia, you name it. They're all in the same boat on this one. So that has an enormous impact because the world, again, the financial systems, they're really good at absorbing big positive flows of things. No problem. We'll find a crevice for that money to go into. That's been happening for a very long time. People, institutions, systems got used to that, and that's now shifting. So that's another sort of body blow to the direction and shape of global capital flows.
So there is two camps right now. A lot of people are talking about inflation hitting the United States, and then we're seeing deflation Which do you think is going to occur?
It's going to be deflation, then inflation. So to be clear, inflation and deflation is a monetary phenomenon to me. The prices are a symptom of that. So when I talk about inflation or deflation, I'm talking about the expansion or contraction of money and credit. And so I think the first thing we're going to be facing is a pretty big contraction of money and credit. We're seeing that already in China. They just ran out of new things to loan into, and then old debts are about to go bust because they were bad debts. Look at margin debt in the NYSE right now is at all-time highs. It's kicking around $500 billion right there. All the speculative flows of money with all the shadow banking and the hedge funds, private equity guys and gals who are busy, borrowing and then leveraging up. All of that's kind of in the process of unwinding right now. That's what we're seeing when you see, say, Brazil, you see their interest rates shoot up and their currency, the real, shoot down. That's just carry trade stuff being unwound. That means that whoever borrowed money to go invest in Brazil is undoing that trade, probably going to be paying down on those old loans. So I'm looking at a first contractionary phase. I'm expecting it to get out of hand. I'm expecting the Federal Reserve and the Bank of Japan and the ECB to all freak out. And then I'm expecting the next stage of this, which will be the inflationary stage. And my expectation is, I think Jim Rickards nailed it a while ago. This next one won't be QE4, meaning they just do more of that. It doesn't work. They're going to have to get money in the hands of the people. They might not do it directly. I might not get a check from the Fed. It won't be that simple. But it will probably be a tax holiday for this year, or maybe a tax rebate for the last 2 years. Here's your income taxes back. Please spend them. With, of course, the federal government going very deeply into debt, and then the Fed monetizing that debt. We'll just do one little hop, skip, and a jump, and people all pretend like that's okay. That's the kind of thing I'm expecting. And then when we get to that part of the story, when we're seeing that overt, direct money printing going into the hands of people or businesses, however it gets distributed, that's when I will be running to buy everything that's not nailed down at that point in time. But for now, I'm expecting deflation, so I'm actually in a cash building position now.
So let me ask you, we saw 2008, and I heard you saying that this is a run-up to a big collapse. Do you see this collapse maybe happening this year or next year?
Yeah, I think 2015-16 with 2016 is kind of I think has a better shot, but we'll see what this fall brings. Fall's always an interesting time in markets in the Northern Hemisphere, so we'll see what happens. But it could happen anytime. Look, the tinder's been laid, and people are saying, oh, was it China? Was it this? Was it the yuan devaluation? Maybe that was the spark, but let's look at all the tinder that got laid. So, my views on this is, look, my original prescription diagnosis was too much debt. And since 2008, what happened, right? Are sovereign debts higher or lower? Well, they're a lot higher. Do we have more derivatives or fewer derivatives on the book? Well, we got more. We got a lot more. Are the too big to fail banks, are they bigger or smaller? Well, they're bigger, right? So all the things that were like key risk factors to begin with, and I could mention others, those are all larger, not smaller. And so what I'm looking for is that when this bonfire gets started, what's really the biggest pile of tinder, though, is this idea that we have built ourselves up to a position of $200 trillion of debt worldwide. I think that's going to have to get reduced to a much more normal, historically average number compared to GDP. That would mean $40 to $70 trillion of it has to be evaporated somehow. Maybe there's some overshoot. Maybe 100 trillion gets wiped out, right? It's very bad, right? This is going to ruin retirement dreams. Pensions are out the window. You can forget about all sorts of social programs. Government spending is going to have to get just slashed horrifically. A lot of people get out of work. This is not going to be a pleasant process. It's why everybody is fighting. Everybody in power is fighting to just keep it going a little longer. I can respect that and understand that. What I can't respect and understand is how they don't have they don't have a plan. There's no plan B. It's like, we're just going to keep this all growing forever. And, my larger work is that we can't grow an economy infinitely on a finite planet. It just doesn't. It's sooner or later, it doesn't work. Just any sixth grader can work that out, right? So that's the bigger problem, is that we've wedded ourselves to a system that's either expanding or collapsing. And that's not an awesome system.
Now, Bill, I had an interview with Bill Holter, and he was talking about the credit drying up, supply chains breaking down. I mean, do you see the same thing happening? Or, I mean, because if I remember back in 2008 when they were in front of Congress, the bankers, talking about how they need these bailouts and the corporations need the bailouts, and if we don't have this, we're going to see riots in the street. And of course, we handed over the money. And this time around, we know things have gotten worse. We know, a lot of people lost their homes, their jobs. They never really recovered. A lot of people are still hurting from that time period. Do you see a complete breakdown of the system when this all happens?
Well, that's a possibility, and it's I'm not saying it's like 100% possibility or even like a 10% possibility, but even if it's a 5% possibility, if you said, Chris, here's a gun, it's got 20 chambers in it, pull the trigger, I wouldn't do it, right? I've prepared as if these sorts of breakdowns are possible. So let's look at what's happening in Venezuela right now, right? So this is the same thing that happens when your money systems break. Your money system is actually your social contract. So when your social contract breaks, everything breaks, right? And in Venezuela, it's not because people don't want to eat and they don't want goods and they're not willing to work or any of that stuff. It's just like the Great Depression. You had people, factories, raw resources, the desire to work, but the money system broke. So when money systems break, everything tends to break. Resources dry up. Credit lines break. International trade breaks down. But we have this global economy now. So if you said, wow, global trade really broke down on this basis, letters of credit were no longer honored and sort of everything slowed down because countries didn't trust each other and payments had to be settled in something real, whether it was wheat or oil or gold or something tangible, everything would sort of slow. Well, all you have to do is pick up the mouse on your desk or look at the pants you're wearing and realize, you're wearing things that probably took tens of thousands of miles of travel through their component pieces to be fashioned and to arrive where you buy them. So those global chains are very cost effective, but they're not very robust. We saw this with the earthquake and tsunami in 2011. There was one plant in Japan that manufactured a certain gel polymer that was necessary to make certain types of lithium batteries. And that was it. There was that one plant, and it got wiped out. And it turned out that there was an enormous problem in sourcing the lithium batteries for all of our components in cell phones or whatnot. So there was a big giant hiccup in the supply chain. So yeah, I think our supply chains are wonderful and complex and sophisticated, but they're not terribly resilient. So I fashioned my own life around the idea that the various support systems that I'm really relying on, I don't want to be 100% reliant on them anymore. So I'm no longer 100% reliant on systems for my food, for my primary energy, for my water, for the basics of life. And I'm not one of these people who's like completely self-sufficient, not even close. But the difference of trying to go from 0% self-sufficient, say in food, to something more than that is a really difficult proposition. To go from 3% or 5% to more is easy because you have the knowledge in place, you've got the infrastructure, you've got whatever improvements needed to be made. So yes, we at Peak Prosperity, we're all about how you become financially, emotionally, and physically resilient so that you can thrive in the coming times.
So what I'm getting out of this is that you're saying that you're preparing right now for something and you're making sure that you have the ability to survive what is coming.
Yeah, not just survive, but thrive. So here's the larger view just economically. What we're about to experience if we go through this big deflationary impulse that I think is coming, people are going to write about this, you're going to read about it, it's going to be all over the airwaves that this was a period of extraordinary wealth destruction. And that's how most people are going to experience it. Wow, I had $1 million in a 401k and it's worth $100,000. That's just, what an awful destruction. My future is ruined. But if you follow this story carefully, you learn that the markers for wealth, this is stocks, bonds, it's currency itself, debts, those are actually markers for wealth. They're claims on wealth. So money is a claim on real wealth. What's real wealth? Well, real wealth is the stuff you buy with money, right? Money has no value to me if I can't buy something with it, right? So what's real wealth then? Well, real wealth is a Tesla, it's a home, it's a college education you can buy. It's the stuff you use money for. So the truth is that a lot of money, a lot of claims on wealth are going to be destroyed, no question. But if you follow this story carefully, the way we look at it, it's what actually is going to happen is this is going to be one of the biggest periods of wealth transfer in all of history. And that's what happened in the 1930s. People are like, oh, the Great Depression, look at all the wealth that was destroyed. No. It got transferred. Farmers lost their farms, but the correct question isn't to focus on that poor farmer who lost his farm. The correct question you want to ask is who got the farm? Because that changed enormously. So we think we're in a period of incredible wealth transfer that's coming up. And again, it's going to be one of these deals where you look at what happened in Weimar Germany from 1918 to 1923, explosive hyperinflation, trillions of percent of inflation. It all got wiped out. People were absolutely crushed, middle class wiped out. But if you follow the story, you see, wow, there were the same number of factories, hotels, homes, productive assets, arable acres of farmland. None of that changed even a whit from point A to point B, but who owned it? Now that changed.
Thank you for being on Spotlight. I really do appreciate it. He has his book, Crash Course, a new book coming out, Prosper. I'll put all the links at the bottom of the video. Thank you very much for coming on today.
Pleasure's been mine.